the way this guy I'm about to show you described covered call ETFs. I'm about to read it to you. If you hate my voice, mute it. You can follow along. I am going to scroll down. I did double check. I didn't see any cussing to get this video flagged. But basically, a really good explanation. I'm going to show you guys another one in a second. He said, think of it like this. Instead of just buying and holding a stock, these ETFs try to make extra income by selling call options. Selling a call option means they're basically renting out the potential upside of the stock to someone else in exchange for cash, called a premium. Are they shorting the stock? No. Selling a call option isn't the same thing as shorting. They don't actually bet against the stock. They just limit how much they can gain from it. Shouldn't the ETF move opposite to the stock? Not quite. The ETF still benefits when the stock goes up, just not as much as owning the stock outright. But when the stock drops, the ETF also takes a hit. So it's still correlated with the stock, just in a capped way. Why does the ETF lose value over time? Because over time, stocks, especially big ones, tend to go up, and these ETFs give away a chunk of their upside in exchange for income. So while they pay out cash on the regular, I cannot pronounce that correctly, their long-term value can erode since they don't fully capture stock gains. Do they do better if the stock crashes? Not really. The ETF might still collect some income from selling options, but if the stock tanks, the ETF will likely drop too. They do best when the stock moves sideways or only goes up a little bit. In short, they trade long-term growth for short-term payouts. Good for income, but not ideal if you want the big stock gains, which we saw. I did a video, I showed AVGO versus AVGW. AVGW is a little bit too new for you guys to see that, and that is also Roundhill. It is not YieldMax. They're currently discussing covered call YieldMax. And then I compared TSLY versus TSLA. If you bought it at the right time and you sold at the right time, it's very easy to make a $200 gain on TSLA. Versus TSLY or TSLW, you would just be getting, payouts, and you guys get the point. I'm going to scroll slowly. I don't feel like reading all this. Some people do consider your YieldMax and all ETFs, I'm tongue-tied. They consider YieldMax all ETFs garbage. I don't. I say it is always based on whatever stock you buy and when you buy it. If you bought SMCY or MRNY, both of those are YieldMax, you would consider YieldMax garbage because they just lost you money. They didn't really make you anything. Even when you bought it, it just continued to go down. But had you bought MVDY at the right time, had you bought MRNY, not MRNY, I just said it, MSTY. If you bought MSTY last year, you would have considered it exceptional. If you bought CONY at the right time, you would have thought it was great. So it really depends on which stock you buy, which ETF, and when you buy it. But that's true of any stock in the stock market. When you buy it matters. Some, doesn't matter when you buy it, they're going to fail you. And that's just a risk you take when you invest. Right? The other explanation I really loved, I'm just slowly scrolling for those of you that want to pause and read. I love this guy's explanation. This is how I view it. This is how I view most REITs and ETFs that make you money and pay you every single month. He said, my way to explain it is if you ran a delivery service and bought a truck to make deliveries, which made you an income. The truck is costly, but as you start driving it and making deliveries, it starts losing value. We call that depreciation. As the truck loses value, it continues to be used to deliver items and bring in income. Side note, you also, if you didn't know, depreciation, when you own an investment and it goes down over time, that's a tax write-off. So it still kind of helps you even though it's going down. The idea is that over time, the income from the deliveries completely pays for the truck, but the truck still runs and brings in income sometime afterward. Covered calls can profit from the stock moving up, staying about the same, and even if the stock drops by the same amount. In addition to the short call, there's also a short put push long call option. Plus, they hold treasuries and another source of income to pay dividends, which is why I say they're based on the ETF. The ETFs are based on the bigger stocks, but they do have other little investments included, and you can go to the YieldMax website and see. But if you're like me and you don't want to have to spend hours and you want easier explanations, those were good explanations, you can go to the YieldMax website. And yes, they describe what they do. They describe covered call strategies. A lot of us just prefer analogies. It helps. It's one thing to read information. It's another thing to memorize it and actually be able to apply it, right? But yeah, you guys can see all this online for yourself. I hope this helps somebody that was struggling a little bit. Find the thread online, thumbs up the person, have a great day and happy investing.